What is stock diversification, and how can it stop you from chucking yourself out of a window every time the Dow Jones decides that it's going to do what it wants to and not agree with the vision you have for your life? The intro to this video, I was channeling my inner Jim Cramer, who always looks like he's on the verge of a stroke. I am a registered nurse, and I am telling you, somebody send that man a Massage Envy gift card because he looks stressed. Hey guys, it's your girl Jackie coming at you with a money talk on personal finance, investing, and debt videos on a weekly basis. Join me. Come join me. Be my friend. Join me by hitting that subscribe button so that you can be notified every single time I have a brand new video up. Today we are talking about stock diversification and why you should care what it is. Let's jump right in. Alright guys, the truth is that no investing, there is not a single type of investing that does not come with risks. We all know this. But if you follow my channel, you would know that not every single stock, bond, commodity is built the same with regards to risk. One of the ways that we can very effectively mitigate that risk is by diversifying what it is that we have in our portfolios. That means, basically in a nutshell, that the more you have in terms of different types of stocks, bonds, investments that all have different risk levels, the less likely you are to really incur some really severe drops in terms of your portfolio funds whenever things start to go south, because not every single type of stock, bond, commodity is built equally. Not everything is going to start to go down in value at the same exact time. And in fact, what it is that we find with the stock market is that when certain types of stocks, bonds, or commodities are going down, other ones will actually maintain their same exact value or even go up. So having a nice spread out diversification of all of these different types will definitely help to keep you sane. In terms of risk, your lower risk assets are usually not super popular. And the reason is because there isn't usually a ton of return on investment, especially in comparison to other investment options. So for that reason, they're not like super popular. But one of the reasons that a lot of people like them is because they're a lot less volatile. So things such as having your money available in CDs or certificate of deposit with your bank, savings account, and bonds are a great way to keep your assets stable. They're not going to go up in value very much. There's not a super high rate of return on investment on these, but they're going to be safe and secure and for the most part stagnant. So yeah. In terms of risk in the middle, we have things like index funds, which I'm a huge fan of, mutual funds, and also things like corporate bonds, which have a slightly higher rate of return on investment than the things that we talked about in the lower tier, but they're not as volatile as the things higher up on the risk scale, which would include regular stocks, collectibles, and even more high-risk investment vehicles that I'm not particularly familiar with. I don't even know what some of these are. But definitely those are the more high-risk investment options, investment vehicles that are available. They probably could potentially have a very high rate of return, but they're also very volatile, which means they're up one day, they're down the next. They're up the next day, who knows from there. A lot of volatility with the high-risk investments. So as I alluded to in the beginning of the video, having nice diversification in your actual portfolio is going to mean having a certain amount of all of these different types of stocks, bonds, and commodities in all three different tier levels of risk. The other thing too that I've been reading about in my research is that how much you have of each particular risk type is supposed to vary specifically on how close you are to retirement, aka your age. So what it is that I'm finding is with like different strategies, the most popular strategy is that the younger you are, the more high risk, high volatile investments you're probably going to have in your portfolio, because it makes sense. A, there's potential for a lot of growth over time because you have a long time yet until you retire, right? And B, if anything happens, you still have time to recover, right? If there's a sharp drop, but I'm not going to retire for another 30 years, it's like it's going to come back up again. I'm sure it is. So definitely the farther out you are from retirement, the more you can afford to have more high risk, high volatile investments versus somebody who is in their 50s, is in their 60s. Maybe they're going to need that retirement money sooner rather than later. Does it make sense for them to have a lot of high risk investments in their portfolio? No, it does not. So what I'm noticing is with financial advisors, what it is that they'll do, and even with like target date funds, what it is that they'll do is the closer you get to retirement, the more they start to switch out the more high risk investments for the super, super low risk investments, because we've already been in the markets for 30, 40 years. We've done our time. We're approaching retirement very, very soon. So we're not looking for a lot of exponential growth. That would be nice, right? But we're not necessarily needing that. What we're needing is stability and safety and calmness as you approach your 50s and 60s and are getting ready to retire. If you're doing all of your own financial planning, like for your own personal life, you obviously don't have to follow that particular guideline. It's just something that I'm noticing a lot of finance professionals will definitely recommend. Is kind of diversifying your portfolio based off of your age in terms of what risks you should be taking versus not. And another fun thing that I kind of like to do, and you guys can leave me a comment below if you would be interested to do this as well, is kind of like typing in your favorite like celebrity, like Warren Buffett or whatever, and then right after their name just putting in like stock diversification, just to see if maybe they've like publicly talked about how they like to diversify their portfolio, or put in like your favorite celebrity's name and then like asset allocation, just like type it into like a search engine or Google or whatever, just to kind of see like how it is that that person invests. It's actually very interesting. I highly recommend it. So if you end up doing it, be sure to like comment below with which celebrity it is that you did. I would love to know. Like, I want to know, how does Lenny Kravitz invest? What does Lenny Kravitz invest in? I need to know. I hope you don't judge me for being a fangirl, and I want to thank you for watching this video with me. That pretty much concludes our video. Definitely, as mentioned, nothing that I provide in any of my videos is in any way, shape, or form close to financial advice. I am very much a novice myself and am in the learning stages of personal finance, and I just like to share with you guys what it is that I learned. So definitely, if you like this video, be sure to hit the like button. Be sure to subscribe if you're not currently subscribed. And be sure to check out my blog, you guys. A lot of times I post things that I don't post on my channel, and the content is very similar, but sometimes it's different. I just feel like I have more creative liberties on my blog. Anyway, be sure to check it out at focusedfrugalfab.com. And I hope you enjoyed this video. Thanks for watching. I'll see you guys on the next one. Bye. Oh, baby. Yes, show me that asset allocation.